One. All right. I think I'm live. Give a quick big shout out to my podcast engineer, Anton, for getting all this set up. So, listen, you know, uh, first of all, happy snow day if you're here in the DMV. It's not a happy snow day if you are somebody who has to shovel the snow like me. I was just doing that a few minutes ago, trying to get some quick exercise and get myself hyped up and amped up for this Facebook Live. But listen, I wanted to talk to everyone today about setting you free with regards to the truth and forbearances. Okay. I'm just going to share information. I will share definitely some of my opinion, but I'm not going to put down anybody. I'm not here to judge. That is not why I'm doing this. But I've heard some information recently on some different podcasts, different videos, different articles. And you know how we do here at Visionary Lending. We keep it real. We're very honest. And, we're here as advocates to represent people to make sure that you have the information that you need to make the most informed decision. So let's talk today about forbearances, okay? And really dig in for a few minutes. And again, I'm taking some live Q&A. So if you see my eyes leave the screen, I'm either writing something down, I'm getting some coffee, I'm checking out the notes, whatever it is, okay? Forbearances, well, what is it? So in the past, way before 2019, let's say you had student loans. And for whatever reason, either you weren't making a lot of money or you had a financial difficulty, you could reach out to your student loan servicer and ask for something called a forbearance. And to put it in plain English, it means, okay, there is a particular financial situation or circumstance that you are experiencing where you cannot make your payment. So they say, okay, in the past for student loans, it was like 12 months or something like that. But just the general concept is that for a period of time, that creditor will say, you do not have to make your payment. Okay. Well, on the surface, that looks really good. Okay. And we'll kind of come back to that. So, and with COVID, the advent of COVID at the end of 2019 coming into 2019, there was legislation passed and a lot of governmental support with regards to people not having to pay their mortgages. Well, you got to ask yourself the reason why. This was not arbitrary. The reason why is because many sectors of the U.S. economy were greatly affected and hit due to the loss of jobs as a result of COVID. When you have a loss of jobs, you have a loss of income. When you have a loss of income, you have a loss of the ability to pay your bills, right? So forbearance in this particular instance and connection is the mortgage company said, okay, you can take a 4-month span, an 8-month span, maybe a 12-month span, and you do not have to pay your mortgage. People are like, great. All you had to do essentially was call, maybe give some type of a situation. Me personally, we're not in forbearance, so I don't know the full application process. But it seems like it was a pretty easy one for millions of people to do. Now, if you legit lost your job, your hours went down, your wages went down, well, being in a forbearance is a good thing because it helps you and your budget and it helps you and your family for a period of time to not have to pay the mortgage. So you can put that money toward putting food on your plate, right? Putting clothes on the backs of your kids, keeping your home warm, or, paying other bills. All right. However, understand that being in a mortgage forbearance, basically meaning the mortgage company says, hey, you don't have to make your payments for a while, no problem. And we're not even going to report you as being late on your credit report. What you do not see is this, and this is one of the reasons why I'm doing this podcast right now, or this Facebook Live, is that number one, it is not done for free. It is not free money. Okay, let me repeat that loud and clear. It is not free money. All of the principal and interest that you would have paid that you did not pay as a result of the forbearance gets added on to your loan on what's called the back end. So that money is still there. You just don't owe it right now, but you will owe it when you either have to do a refinance or you sell your home. All right. Okay. So the forbearance is not forgiveness. Let's make that very clear. Do not mistake those two terms and even the meaning behind those two terms, to be perfectly honest with you. All right. Furthermore, if you are a homeowner and you are currently in a forbearance, okay, and you want to refinance your house, you will not be able to refinance your house. Let me repeat that. If you are currently in a forbearance, okay, and you want to take advantage of the 2.5, 2.6, 2.7% interest rates, you will not, unequivocally, you will not be able to. Okay. Well, why not? You have a 720 FICO score, 740 FICO score. You have equity in your home. You should be able to refinance. Listen, when a lender looks at your credit report, an underwriter, a bank, whatever, and they see that you're in forbearance, what do they see? They see that you are currently not paying your mortgage. Okay. Period. Done. End. Okay. So they have no indicator whatsoever that you can actually pay your mortgage once it comes back due, even though you may make six figures, even though your household income is very healthy and you can document that through pay stubs and W-2s and this and that. It does not matter. Okay. Basically, think about when your man was it Tom Cruise was like, show me the money, right? Show me the money. Think about it like that. Banks are like, show me that you can actually pay your mortgage on time. So what do? They say, okay, fine, you're in a forbearance. Come out of the forbearance and make 3 consecutive on-time payments. Not 3 weeks in a row. No, 3 months in a row. January, February, March, April, 3 in a row. That will document and substantiate the fact that you can make 3 payments in a row. Okay. All right. So let's make sure to understand. And I think someone has a question. It says here, can you buy another property that's currently in forbearance? Well, that's a good question. That's from Silvana. So if someone's home is in forbearance, they still own the home. So let's kind of flip it real quick. You're talking about foreclosure versus forbearance, 2 completely different things, 2 completely different situations, but I'm happy to answer the question. Again, to reiterate, a forbearance is when you are living in your home, you're chilling, you're eating dinner, you're hanging out, everything's good. All right. But you've decided to take advantage of a program that says, okay, due to COVID and due to the resulting effect on society and the economy, you don't have to pay your mortgage for a certain period of time. Okay. It doesn't mean that you're in danger of being kicked out of your house. However, when you have a foreclosure, it's a completely different situation. It's the unfortunate situation that families or individuals run into when they have not been able to pay their mortgage at all. Okay, at all, because of various financial or whatever circumstances. It's not a forbearance. And so the house is like, yep, thank you, John. Cuba Gooding Jr. That's right. I like to air dry. So anyway, with a foreclosure, you haven't paid your mortgage for a long time. And the bank's like, look, we're going to come and the house is now ours. We own the house. Okay. And unless you bring it completely current, or unless you make some type of a plan, you are going to have to leave because we are now the owners of the home and we are selling it. Okay. Banks don't like to do that because typically they only sell it for a percentage of what it's worth. And they will have someone called an asset manager who handles tens of thousands or thousands of these cases. Okay. And when it comes to banks, it is all down to a financial decision when they are looking to sell your home when you are in a foreclosure. So that is the worst possible situation for you if you are a homeowner. Furthermore, it's one of the worst possible situations for your credit because it'll drop your score 150 points. It takes years to recover, from that in terms of being able to qualify to purchase another home. So again, my heart goes out to families who may be in that situation, but a forbearance and a foreclosure are two completely different things. So to get back to the forbearance, again, it's not free money. And then understand that you have to be out of the forbearance for a certain period of time. Document the fact that you've paid your mortgage for a certain period of time on time. Okay. Then you will be qualified for financing, FHA, VA, conventional. Okay, let me repeat that. FHA, the Federal Housing Administration. Conventional, Fannie Mae, Freddie Mac. the VA. Did I say that's it already? Whatever. Uh, so you will be qualified after that period of time. And I think there's been a misunderstanding because what happens is when these banks are talking to people and they're considering going into a forbearance, they're not fully explained what the ramifications are. Okay. If you want to sell, if you want to, look, you could be in forbearance on your current home and you may want to purchase a investment property. Okay. Well, that investment property has nothing to do with your current home. Yes, it does. Okay. You have demonstrated that you're not paying a mortgage right now on time. So it represents a higher risk to the bank to then extend you financing, because how do they know you're not going to go in forbearance or you're not going to be able to pay that investment property? It has nothing to do with you personally as an individual. Furthermore, let me break it down. It has nothing to do with your skin color. It has nothing to do with where you're from. It has to do with the amount of risk tolerance a bank has when it comes to someone being in a forbearance situation. Okay, so let me grab a quick sip. So let's talk about another topic that people need to understand, which is loan modifications. Okay, loan modifications. Now, what is a loan modification? A loan modification is not a forbearance. Okay, a loan modification basically is when you have to go through a process with your current mortgage holder, current mortgage lender or servicer, and you say, look, I need to make a lower payment. This payment right now is very financially strenuous for myself or for my family. Can we get a lower interest rate? Can we get a lower monthly payment? So there are going to be two different types of loan modifications that you're going to go through, either a trial basis or a formal complete loan modification. All right. If you are in a loan modification, you will not be able to refinance your house because it is not a true representation of what your actual mortgage payment will be. So any lender that wants you to refinance, or if you want to go to some loan officer or somewhere, they're going to say, you're in a modification. You need to make how many payments on time to show that it is demonstrated? Uno, dos, tres. That's right. That's the magic number for today. 3. Okay. Remember that. Remember that. I do not want you to unintendedly put yourself in a situation to not be able to take advantage of these low interest rates. Now, here's the deal. There are people that are doing a loan modification and they're getting a rate of 2.875 or 2.99. Why do that when you can just refinance your house? If you have a decent credit score, and if you have, 3, 5, maybe 7%, give or take, of equity where you can build in the closing costs into your loan, then just go ahead and do a refinance altogether and avoid the loan modification, because it does not have a positive effect on your credit. It does not have a positive effect when a bank is looking to extend you financing. It just simply doesn't. And I think that people have been miseducated, or undereducated on the issue, to be perfectly honest with you. Now, I was listening to a podcast about a week ago of a very famous realtor who's also a real estate coach. He's out in California, and he was talking to someone about forbearance. Just to let you know, my little ring light thing just went out. So sorry if it got a little bit darker all of a sudden. Ugh. Anyway, let me just see if I can fix this. So here's the deal. If you look at the number of forbearances that are taking place right now, here's the statistic that they gave. They said, well, a lot of people who are in a forbearance right now are in a really good situation. They were saying on this podcast, because they have at least 11% equity in their home. So yeah, they'll be in a good position. Once they're out of forbearance, they can sell their house because they have 11% equity. And I thought about that and I was like, this is so misleading, to be honest with you. It's very misleading. And let me break it down to you why. Let's say, I wish I should have prepared to share my screen. So sorry about that. But let's say if you have a $400,000 house. Let's just look at that, for example, $400,000 house, and you have 11% equity. Okay, because that's what the statistics are saying that people are in forbearance currently have. So they're in good shape. And you want to sell your house. $400,000. at 11%, I think is what, 400, 400 and it's like $44,000, right? So let me just do some quick math. I don't know if it's going to show up on my screen or not, but whatever. So it's $44,000. All right. I don't know if I just came off the screen or not, but there we go. You have $44,000 of equity in your house. Woohoo! You want to sell your house. If you have a realtor representing you, a listing agent and a buyer's agent, and let's say on the low end, they both get 2.5% commission. That is 5% commission. Okay. So now you take 400,000 times 5%, which is 20 grand. So now you take your 44% of equity that you have, $44,000 of equity, you subtract out 20 grand that you pay to your realtors, which leaves you $24,000 of net equity left. Well, when you sell your home, typically you'll have at least $2,000 to $3,000 of closing fees on the good end that will, be paid by you as a seller. So now let's say you have about $21,000 after paying your realtors, after paying your seller related closing fees. Now you're at about $21,000 net equity left. Now you want to go buy a house, okay? Because maybe you want to upgrade or something. Well, if you want to upgrade a little bit and go from a $400,000 house to a $450,000, well, if you put down the minimum of a 3% down payment, right? Watch this. So at $450,000, your minimum down payment is going to be 13 grand. Plus, you're going to have like another 9 grand on top of that for closing costs, because in this seller's market, no seller is going to give you closing costs, right? You have just used every dime of your net equity from selling your house, every single dime. Now, again, there may be people who are in a different position, right? And they have more money set aside. But what I'm saying is this, okay? And this is to debunk the miseducation that was on that podcast, live and direct. And I encourage everybody and anybody who's watching this, if you want to call in, if you want to send me a note, if you want to challenge what I'm saying, please go ahead and do so. If you are selling your house and you have $44,000 of net equity, after you pay your realtors, after you pay your seller related closing fees, after you turn around and you want to go buy another property of similar or increased value, with your down payment and with your portion of the closing costs, you will spend everything. If you want to go ahead and spend everything and that's what your financial plan is, then fantastic. I'm not going to dish you. I'm not going to judge you. But what I'm saying is that it just doesn't work as far as I'm concerned. You want to have some money left over. You don't want to spend everything that's in the piggy bank. Okay. And I think it's very important for people to be properly educated. Last thing that I'm going to mention on this Facebook Live is this. I've gotten various questions with regards to what's the difference. My headset is like crazy weird. Hold on for a second. Yeah, I think it looks better now. Like, what's the difference between a buyer's market and a seller's market? Okay, so I'm going to make it really simple. Like your man, Denzel Washington said in the movie Philadelphia, I'm going to explain it to you like you're like a 5-year-old, right? But you're not 5-year-olds, but I'm going to explain it really simply and I'm going to break it down. Here is a seller's market. You have 3 people. The magic number for today is 3. Where are my fingers? There they go. You have 3 people who are selling their home. You have 10 people who are interested in buying that home. Okay. It is simple economics. It is what's called supply and demand. The supply is 3 people who are selling their home. The demand, there are 10 people interested in purchasing those 3 homes. So for every home, right, you will have 3.3 individuals who are interested in purchasing that home, putting an offer in. As a result, thank you. My wife, Jen, said it's a 4-year-old. So for every house that you're looking to sell, every seller has 3 offers that they can look at and choose from on what they feel would be the best offer for them. Okay. So it is more competition, and it's good for the seller because now they get to choose what they deem and feel is the best terms, but it's not as good for the buyers because now, you have what's called in the realtor world, a multiple offer situation. Okay. That's what they always say. Well, we have a multiple offer situation. I'm so tired of hearing those words, but That's basically what a seller's market is. So, hey, the seller gets to choose. So, which leads me to something else that I have got to talk about. I have got to talk about. So, please share this with everybody. It is my personal opinion. Okay. And yes, it is the personal opinion of Visionary Lending. So, there's no disclaimer because I own Visionary Lending. It is our opinion that a lot of realtors, what they're saying today is, oh, well, we're not accepting FHA offers on single family properties or multi units. And let me tell you, I really believe that that is a form of very subtle discrimination. Yes, I said it, and yes, I meant it. And now I'm about to break it down and back it up. FHA loans historically and today have the perception and the unfair stereotype that buyers are less qualified to purchase the home, which is completely untrue. It just FHA is just not as FICO credit score driven as conventional loans are at Fannie Mae, Freddie Mac. It is simply true. Okay. Furthermore, a lot of listing agents will say, well, we might have issues with the appraisal because FHA, not true. An appraiser that is going to appraise a home is going to use the exact same comparables, okay, for a FHA loan that they will for a conventional loan. Your home is primarily, not completely, but primarily based off of the value of the homes of similar square footage, number of bedrooms and bathrooms, right, within a mile to a mile and a half radius that have sold within the last few months. Plain and simple. Now, they will add, of course, if you've done some nice upgrades and different features to your home, if you have a finished basement versus a non-finished basement, that type of thing. Well, of course, that's going to add value to your home. But by and large, the comparables are the comparables. FHA will look at the safety related issues in the home, which anyone should look at. Okay. Yes, thank you, Chris, because there is disparate impact and undercover discrimination. That's what we're talking about. FHA is going to look at this. Do you got broken windows? Do you have rust? Do you have steps without railings? Do you have, chipping paint? Those are safety related issues primarily that the FHA is going to look for, that a conventional appraisal or loan appraiser may not necessarily note. And it really does depend upon the appraiser. It is up to their discretion. So you mean to tell me that if you have a strong offer to purchase a home that is FHA, strong offer, the listing agent, listen, the buyers sellers most times, I'm not going to speak on behalf of all sellers. Most times sellers don't know the realtor is the one that is guiding them. Your realtor is your advisor. Okay. And your realtor will say, this is a conventional, offer. Okay. Looks good. And here's an FHA offer, which may be more, but I'm telling you, I have seen it. I've seen it. That they would say, well, Matt, you may want to shy away from this FHA offer. And the seller may not even know why, but they're going to take the advice and guidance of their realtor. So I don't want to hear it. I do not want to hear the nonsense when realtors say, oh, well, yeah, well, the seller was more concerned about the FHA financing. No, they were more concerned because you made them concerned. Take ownership and take responsibility for it. It's the truth. Listen, okay, an FHA buyer can be just as strong, if not stronger, than a conventional buyer. Just because someone's credit score might be 645, someone else's might be 745, you don't know the reasons why. You don't know what's going on behind that. You don't know how much money the person has in the bank, their TSP, their 401k, their TD, Ameritrade. You don't know what their income is. You don't know what their debt to income ratio is. You don't know any of that. The loan officer knows that. All you see is conventional. And so you automatically assume that it's stronger and it's better. And it's simply not true. And I would challenge anybody, absolutely anybody, to send me statistics specifically on appraisals where FHA appraisals normally, systematically come in lower than conventional appraisals. I don't think it exists. Prove me wrong. Okay. What's been going on is there's been a lot of undercover and in your face discrimination against minority groups because some minority groups are using FHA loans for various reasons. And as far as I'm concerned, I think it's just very subtle, and I think it's an undercurrent, and it's not fair. It's simply not fair. And it's just another way to try to hold people down. But I am on Facebook Live right now breaking down the facts and the truth, because we are here to educate people. We are here to advocate for people. We're not just here to talk. We're here to actually say, this is how you're qualified for a loan. This is how you get your credit better. This is how appraisals work. Okay. This is what you're entitled. This is what you're entitled to when you're making an offer on a home. We want to help as many people as possible. It doesn't matter what your skin color is or what language you speak or where you're from. We are an advocate, and we're here to be a voice for the voiceless. Okay. And to help people to understand stuff like forbearances and foreclosures and modifications, right? And to understand what the real math is really about. Okay. And to debunk myths and nonsense that's out there. We're local right here in Woodbridge, Virginia, and we help people in the DMV. Okay. So again, hey, if I sound like I'm preaching, lo siento, I am sorry. I just wanted to tell the truth to everyone today. If there's any particular topic that you would like for me to talk about, please send me an email, brandon@visionarylending.net. Check out our YouTube page. Okay. Visionary Lending. Check out our Facebook page, Visionary Lending, our Instagram page, Visionary Lending, and the same thing with LinkedIn. We have a lot of information that I feel adds value to you. Not trying to sell stuff, not trying to sell you anything. Okay. What I'm trying to do is give you value. Okay. And I'm trying to give you some firm land to stand on. Okay. All right. So I think I'm about done. I definitely appreciate everybody's time. Hopefully that's clear. If you want me to come back with any particular statistics, any additional information that you would feel is healthy, especially if you are in the real estate field. If you feel that anything that I said today is a misrepresentation, please reach out to me, because I'm more than happy to have the conversation. I'm all about just simply helping people to go from point A to point B, right? And making the playing field level and even, so people have the proper opportunity to be able to purchase a home and change their lives for themselves and for their families. So thank you guys. Love you much on this snow day. Definitely, stay safe out there, and I'm signing off. Peace.